What's up YouTube? In today's video, we're going to talk about how to analyze a rental property for absolute beginners. Now, a lot of you are brand new to real estate investing, and the biggest question is if you're going to get into a good deal or not. So today, I'm going to be showing you the different formulas and spreadsheets that I use to determine if a deal is good or not. If you guys don't know who I am, my name is Sean and I make real estate easy. My wife and I own 34 units in different states such as California, Georgia, Texas, and Florida. These are mostly 1 to 4 unit properties, and we've been doing it since 2016, so almost 7 years now. Now, if you watch this video all the way to the end and follow us step by step, then you should know exactly how to analyze a deal. And we're even going to give you a special bonus if you watch this video all the way until the end. Now, before we start analyzing deals, we need to determine what a good deal means to us, because that changes depending on our goals. For example, if you're looking for some quick money, then you'd be more interested in a fix and flip. But if you want something that's more passive and long term, then you might want to start looking at deals that are better for cash flow. So you have to think about what your own goals are. So today we're going to be focusing on buying long-term investments because that's something that my wife and I really like. So the factors that we need to consider are the purchase price of the property, how much can rents actually go for in a specific market. And you can't just assume that your property will rent for 2 times what the average rents will be. So you need to analyze all those things too. You also need to consider the location, including different factors like job growth, population growth, your crime rate, etc. So how do you determine what a good deal is? From a very high level point of view, I look at the 1% rule at the start. Because oftentimes, if a property can't even fit the 1% rule, then it's not really worth my time to dig deeper. Now, the 1% rule simply states that the monthly gross rent should be 1% or higher of the total purchase price. So as an example, if I'm looking at a property that would cost $150,000 for purchase price, then I should be getting $1,500 or more every single month on that rent. So is it hard to get the 1% rule? It can be, and definitely not every single market will work. So for example, if we're looking at the Bay Area, you're buying properties for at least $1 million. The rents there very rarely go over $4,000 a month. So that's 0.4%, and it's nowhere close to the 1% rule. So I personally don't buy any rental properties in the Bay Area, and I try to look out of state. So as an example of that is some of my properties in Jacksonville. I bought one property for $80,000, and on day one, it was already renting for $900 a month. So that means it passed the 1% rule. So again, that's just the first check. It doesn't mean that these properties are going to be great, because again, you could have a property that satisfies the 1% rule, but may not actually be good because of the other factors. Another thing that I really like to look at is the cash on cash return. So that means the net cash flow after paying your property management fees, utilities, property taxes, mortgages, and other miscellaneous expenses, and dividing it all by the money that I put into the property, which includes my down payment, my closing costs, and any repairs I need to get the property ready. I typically want a cash on cash return of over 10%. Now, of course, if you're buying a property without a loan, with pure cash, then typically your cash on cash return is going to be lower. But by buying a property with cash, then obviously you have the stability of knowing that you won't have a mortgage payment to make, and your actual cash flow dollar amount is going to be higher. When we were first getting started, we would always finance everything to the max. But now that we have more income, and now that we're pretty secure with our finances, we're actually buying a lot of properties with cash. We know that from a safety and security point of view, we're definitely a lot safer. If a few of our properties are vacant for a couple of months, it's okay because we don't have a huge mortgage overhead. So now we're gonna go into an actual example of a property and analyze it together. So this is a random property that I found on Zillow. This is a deal that's in Cincinnati. It's $185,000, 3 bedroom, 2 bathroom, 962 square feet. From my initial point of view, I can tell this house looks really nice, right? It looks updated. If I scroll down a little bit to this pricing area, I could see that it was recently sold for $84,000 just a few months ago. And that tells me that this is a flipped property. As an investor, I will probably stay away from a flipped property, but we're gonna continue doing this analysis just so we can see everything. Also, I noticed that this is only 962 square feet. So that's actually pretty small for a 3 bedroom, 2 bath. Typically for a 3 bedroom, 2 bath, I wanna see 1,250 square feet or above, ideally 1,500 square feet. So let's see if these numbers make sense. What I'm going to do is I'm going to go to my property analysis calculator. Now again, if you guys don't have this, you can make one yourself or you can buy this with the link down below. And I'm going to put down $185,000 here. For improvements, this is where you talk about any kind of additions or if you want to pay for any repairs. In this case, I'm going to put 0. My down payment percentage, I want to put as little as possible, so let's put 20%. Interest rates now can vary, but let's put 6.5% for now. I'm gonna do a 30-year mortgage. And to find the total rents per month, I also like to use Zillow. So I close this out, and I can see this is like the area where all the properties are, right? This is the area where this listing is. So instead of looking for sale, I click on for rent. Click on apply, and do something similar, right? 3 bedroom, 2 bathroom. Home type, I wanna look at houses only. So we can see here that we have some properties here, 1,300. It's a little bit bigger. How this one? 1,400. Not bad. Pretty good condition. 1,400. You have some here, but then the square footage is way bigger. So realistically speaking, I think we're going to be somewhere between here, right? The 1,300 and 1,400. Again, to be a little bit more conservative, maybe do 1,250 just because the size is a little bit smaller. Other revenue per month, if you are charging for like pet fees, if you're charging for laundry fees, you can add other revenue per month. But generally speaking, it's probably going to be 0. Vacancy rate, we do like to add a 5% vacancy rate, sometimes 10%, because if your property is vacant, then it typically takes about 2 weeks or so to actually renovate the property, make it ready, and get a new tenant inside. Annual revenue increase, we assume that rents go up every single year, and to be safe, I put 3%. Annual operating expense increase. So same thing, like how much more are your things going to be over time? This is basically with inflation. So you can do 2% or 3% here. Just do 3%. Annual appreciation, like how much do you think this property is going to increase in value? Properties typically increase between 3 and 5% every single year. So you can do 3% again here too. Again, these are all numbers that we like to use to visualize what's going to happen. These are not predictions, right? Like this is never going to be perfect, but you do everything and take it with a grain of salt. Property taxes in Cincinnati are typically 2% of the purchase price. Property management fees, you're probably paying 10% every single month. 1 unit here. Now to find the insurance, what I like to do is go on Steadily. Steadily is a nationwide insurance provider that specializes in creating landlord policies. So if you want to check out Steadily, go ahead and click on the link down below as well. Type in the address here, click on the get quote. You can see that it's a single family, masonry construction type, 1962, and 962 square feet. So they pull all this data from tax records. So it should be very similar to what you see on Zillow here. You can type if it's a long-term rental property or if it's something you're going to rent on Airbnb on a short-term basis. Is it going to be fully occupied or is there going to be some vacancy? After you click continue, you go on this page and you put in your own information. Now after you type this get a quote, you'll know exactly what to put on your spreadsheet. So for now, let's just put $1,000. We're going to do 0 for advertising because our property managers usually handle that. We're going to do 0 for utilities because our tenants usually pay for the utilities. This property doesn't have an HOA, I believe, so HOA dues should be 0. Now this line item for miscellaneous is if you have any miscellaneous costs, again, we'll put 0. And for year built, we'll put 1962. So after putting in all these numbers, we can see if this property is a good deal or not. So based on this top area here, we know this is a bad deal right from the start. Again, this doesn't satisfy the 1% rule at all. It's $185,000, so you should be getting $1,850 a month. You're only getting $1,250 a month, which means that your annual cash flow is going to be negative $4,675. You're going to have a negative 11.49% cash on cash return on investment. Your monthly cash flow is also going to be negative $389. So overall, this is a terrible deal. You don't want to do this one. But let's say we change the numbers a little bit. Let's say we looked at a different property with similar values, except this one did hit the 1% rule. Like I said, this is a flip property, so you probably don't want this one. But just a few months ago, you could buy this one for 84 grand, right? So $84,000. And let's say you put your own money into it. Let's say you put $30,000 into it to renovate it yourself. Now it looks much better. So you can see here your annual cash flow is going to be $3,473. You're going to have a 7.16% cash on cash ROI, and your monthly cash flow is $289 after all expenses. So it's actually pretty decent. With my calculator, I automatically assume we have a 10% expense ratio, which means that for every dollar you get, 10% of that will be in reserves for a big repair. So your actual cash flow will be higher, but down the line, you're gonna have to pay for a roof repair, new AC unit, etc. So we scroll down here, we can see that based on the way we did it, our cash outlay will be $48,480. So that's the $16,000 for your down payment. You have another $1,680 for your closing costs, $30,000 or so for the improvements I said we're going to make. So yeah, so you're in it for $48,000. Your mortgage payment every month is $424. You can see here how I break down the different revenue streams. You get your rental income, you have a small vacancy rate, so your net income is this. And then with property taxes, you have to subtract that much. Insurance, property management, maintenance and repairs, your total expenses is this much every single month. So your net operating income is this much. But of course, you still have a mortgage to pay, so your mortgage reduces it by that much. And then your next cash flow is this much. Now, what I also like to do is like to see what happens in the future too. So this is year 1. What happens in year 2, right? Year 2, your rents go up a little bit more, your expenses go up a little bit more as well, and the numbers change here. And cool thing is I also add this graph here too. So you can see here that over time, your cash on cash return does increase. But what's this? What's this blue one? total return. This is pretty high here, almost 15%. Well, the beauty of it is your net profit from real estate investing isn't just the cash flow you get, it's also the equity you have in your property. And you get equity by paying down your mortgage and by the natural appreciation of the property going up in value. So you can see here, you actually do increase a lot in value over time. So your total ROI, even though your cash on cash ROI is only 7.16%, your total ROI is almost 14%, which is much better than the stock market. Now, this is why buying real estate can be better than investing in stocks because of leverage, because of the different factors that go into the net profit and the total generational wealth you get. Plus, you get tax benefits and all this other good stuff. So of course, there are many factors that go into finding a good deal in the first place. First of all, this deal was on the MLS, which means that thousands of people are potentially seeing this property. If you want to find great deals, you probably need to look off market. Now, the second thing to consider are finding out the actual rents in the area. What I did was my best estimate, but you won't actually know until you actually call a property manager who knows that local market really, really well. They'll be able to tell you, based on your square footage, bedroom, bathroom size, and location, what a property will actually rent for. So then you can go back, adjust your spreadsheet, and double check on the numbers there. Now, if you remember back in the beginning of the video, I said I'd give you guys a special bonus if you made it to the end. Well, if you guys are too lazy to make your own spreadsheet to analyze your own deals, then you can get a copy of mine for 50% off with the coupon and the link down below. So in conclusion, being able to properly analyze a property is very important because if you buy a bad deal, it's very hard to recover. And the worst part is it might discourage you from buying more real estate in the future. Whereas if you start with getting good deals from the very beginning, it'll encourage you to buy more and more, and your net worth will surely explode. Now, if you guys want to learn more about how to invest in real estate, then I highly encourage you guys to attend one of our free masterclasses on how to buy rental properties. We go over everything from the very beginning, and it's all for free, and you can register for the masterclass with the link down below as well. Now, if you want to see another case study of some of our own properties in our portfolio, then you can check out this video here about how much I make on my fourplex in Florida. Thanks for watching, guys. I'll see you next time. Take care.